Hi, and welcome to our LinkedIn Live series on the release of the ISM report on business. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management. That's Institute for Supply Management's member publication. And we're excited that you're able to join us today as we break down the Services PMI data for January. Kind of an interesting month. A post-holiday lull for the services sector is certainly not unusual, especially with winter weather a factor. That might have been the case in January as the services PMI decreased to 52.8%, which of course is still an expansion. And all four sub-indexes that directly factor into the composite reading were in growth territory. And there was even an uptick in employment. And 14 of the 18 industries reported growth. That's up from 9 the previous month. So it was an interesting month. And let's bring in Steve Miller. He's the chair of the ISM Services Business Survey Committee. Steve, how you doing? And just tell us what stood out to you about the January numbers.
Yeah, I'm doing great, Dan. It's 80 degrees here in Dallas today, Dallas area. So it'll be great when it's 35 next week, but you know, we live with it here.
Yeah.
Seems like that's what's happening with the economy as well. We're seeing some ups and downs, and even though January is still an expansion, it's the lowest January reading since 2010. So it's a tale of two cities. We're hoping that the first time in 3 years we saw a second half stronger than a first half. I'm going on record now that I'm thinking that the first half of last year was the bottom, and given what we have in the semi-annual, which is looking at some slight increase in growth this year from a 3.7% to 3.9% growth improvement in the services sector. I'm thinking we're going to see a good year, and this is the beginning of a positive.
Yeah. Well, I know this is your first go around, on the January report as the chair, but I mean, your predecessor Tony Nieves talked a lot about a post-holiday lull at this time of the year, and certainly not unusual. But was that kind of what you expected? Was the degree to it, at least in the composite index number, did that surprise you a little bit?
Yeah, I think at least one person I talked with last month, I told I expected it to be in the 52s this month. So it was, but what I expected was that we were going to see employment drop, and we were going to see supplier deliveries speed up, rather than seeing a drop in both new orders and business activity, based on some of the concerns around tariffs. I was expecting people bringing in more inventory, and we didn't see any of those things happen. We just saw a slowdown there. So I was a bit surprised as to why, but I was pretty happy to see a mid 52 reading, although I was a bit surprised as to why.
Yeah. Well, you mentioned it, and it was certainly a topic of conversation among the panelists, and let's just get it out of the way right at the top. It was obviously a big part changing minute by minute when the manufacturing report on business was released on Monday, and Tim Fiore, the chair of that committee, kind of described it on our call as the shiny object that you kind of have to not try to get distracted by. But it was a subject of comments for a lot of the services panelists as well. And, there was some resolution with Canada and Mexico on Monday, but, there may be some activity, further down the line, as we say that could change day by day with this administration. But just talk about, that dynamic and how the services panelists are responding to it.
So I have a couple of comments, but they're more around supply chain than they are around tariffs, and really the toilet paper effect. People trying to buy inventory or get inventory ahead of an uptick in pricing from a flow through. You load boats now, and you'll be getting inventory in the end of February. If you're trying to beat that tariffs, can they still? I don't know. Has the rush on toilet paper already started? Meaning electronics, electrical equipment, steel from China, chemicals, things like that. I I don't know. We'll see when we start looking at supplier delivery speed and inventories next month. China has a very different outlook on time than we do in the U.S. Okay, so we'll see a slowdown for 3 years, and we'll put through a 30% or a 50% tariff, tit for tat, what comes from the U.S. It on that one. I mean, I don't have any insight into what the geopolitical intentions are within the Trump administration. That's the one I'd be concerned about. I think the actions by Mexico and Canada to help us with the border and potentially fentanyl and that type of thing was exactly what it seemed like we were looking for. I'd be surprised if we see any type of sizable impact, given that the big impact for the U.S. will be two industries that are really important to the Trump administration. One is automotive, and the other one is agriculture. And I think both of them can have a significant hit if we put those tariffs through in Mexico and Canada.
Yeah. Well, let's kind of drill down into some of the particular sub-index numbers. Right now, we could start with employment. Considering there was an ADP report today that was generally well received, I think, and in terms of ISM's data, it seemed like a month of status quo. I mean, companies mostly kept their staffing levels. I mean, the index did increase slightly, and I know we've talked about in the last couple of months that there are a couple of encouraging trends there. Did you kind of see that as just as the continuing of that?
So talk a little bit more about that. What did you see, Dan?
Well, I'll have to get up my other screen here. The employment, I kind of pay attention to, what our respondents tell us in terms of how many companies were a little bit higher and how many were the same. 72.3% of respondents' companies kept their same headcounts. 13.6 was a little bit higher, or said they were higher. That was a little bit down from December. And the 14.1% that was a little bit lower, that was also down from December. So it looks like companies kept their same headcounts, and that all translated into the index going up 1%.
Yeah. One of the things I didn't do is I didn't kind of look back in the kind of the Q4 January kind of transition over time. To me, when I saw the January number still being in expansionary territory, I view that as being very positive. One of the comments I added, I think, was in the ease of hiring. So we're either seeing more people come into the workforce, which is fantastic, or we're seeing, like we saw in the job openings number yesterday, a lower number of job openings than were anticipated. So either way, it looks like people are able to hire and on average are able to bring in more folks. So I think that's a really positive thing from a sustained growth in the services industry, because without people, your revenues are not growing, generally speaking, productivity and that type of thing. But it's built on people in the services industry.
Yeah. And then supplier deliveries, I mean, that was also, it increased slightly. And I know you had a couple comments, one from transportation and warehousing, that cited winter, weather conditions probably playing a factor. Would you attribute that as that index ticking up a little bit and not so much demand?
Yeah, on the inventory specifically?
On supplier deliveries.
Supplier deliveries, yeah. So on the supplier deliveries number, we're the highest that we've been in 3 months. The slowest deliveries then in 3 months, and that seems kind of normal from the other commentary around tariffs. And last month, talking about getting ahead of tariffs by bringing in additional inventories. The thing that was really curious for me, Dan, were 3 indexes together: inventories, the supplier deliveries, and the inventory sentiment. So we had inventory sentiment ticking up, saying we have too much, and we think compared to last month, we have a little bit more too much than we thought last month. Inventories, though, are in contractionary territory a little bit more than it was last month, showing, okay, so inventories are on average going down, and then supplier deliveries ticking up. So the only way I could put the three together is we have too much inventory, maybe of the wrong stuff, trying to get more in, and it's difficult for us to get it in. So our inventories are for the specific things that we're trying to bring in from cross-border are a little bit more difficult than we had hoped.
Yeah, that inventories index, I had planned to ask you about that because Tim Fiore and I talked about that on Monday. There was the same dynamic in the manufacturing index. With all the tariff anxieties, you would have expected that number to be a little bit higher, and it wasn't. Do you think maybe a lot of that panic buying or bulk buying was in December and it just wasn't reflected, in the January data?
Yeah, so the December number was slightly contractionary, but it was up 3.5 points from November. So I think that's definitely part of the dynamic. The other dynamic in the services industry is we're seeing the new orders growing slower, and we're seeing the backlog actually shrinking faster. And so I think that all of the and with an inventory sentiment saying in general we're too high, I think that's all of those together are creating a dynamic where we want to be a little bit more cautious around inventory. If China slaps tariffs on our outgoing products, we don't need to make as much, or we don't need to service as much from we have wholesale trade as one of our big sectors or big industries within our sector. And we don't want to be holding a bunch of inventory in warehouses if all of a sudden we can't move it because it's now 25% more expensive in China, 15% more expensive in Canada, and 50% more expensive in Mexico. So I could see where that would be creating a dynamic of, not sure we want to have this much inventory, drive it down a little bit more. The second half of the story, or maybe third half of the story, Dan, is that we always see inventories drop in January, year over year. The inventories are run down in December to meet the year end accounting commitments, and then we're still in a low inventory position in January, and we start building up in February. Is traditionally how we've seen that index vary over time.
Yeah. The new orders index. You got a lot of questions about that in an earlier interview that I was part of. 51 registered 51.3 in January. That's down from 54.4, and I mean it was up around 50, 56, 57. A few months ago. Yeah. Was that kind of a surprise to you? I mean, not necessarily, not just the January reading, but the way it's been trending.
Well, and going back to the comment around inventories, absolutely it was. Yeah. Usually you see that pick up in new orders because you've got to get your inventory position back in place. Then you drove down so you could hit your financial numbers at year end. So I wasn't expecting that. I wasn't expecting the new business to be a drop either. Those two, especially by more than 3 points each, that was a surprise. But then it is my first January, so next January I may have a different perspective.
Yeah. Prices is always going to get a lot of attention month to month, and it certainly did in December. The highest reading in nearly 2 years. There was some relief on that a little bit this month in January, but it was still a lofty reading above 60%. I mean, just what are some of the takeaways there?
And Dan, so I saw in the folks on the call, there are a few people that I know, and they know I'm a person that loves to get into the numbers and see how all that works together. February and March of 23 was the last time we had 2 consecutive months at 60 and above. February was 64, which was exactly what December was, and March 23 was 60.2, I think it was, or 60.4. It was only 0.2 percentage points off of January's reading. That's when interest rates were at 6% and 5% for consumer goods. The last time we saw that in an uptrend was October of 2020, when we went into that spiraling inflation cycle. So nobody's pumping $1 trillion of cash into people's pockets to go through COVID anymore. And the interest rates are not 2.5%. So hopefully that this isn't a 2-point trend leading to what we saw at the end of 2020 going into very significant inflation. But that one for me is kind of a concern. We're seeing a general trend up and then hitting 62 months in a row. If I were a supply management person, looking at immediate purchases and what I'm expecting from inflation, as I am, that's the one that has me most concerned.
Yeah. And I know we've been, the last couple of months, not only with the, December and January prices index numbers, but also for the economic outlook article that I spoke to you about, that's in our January, February issue of Inside Supply Management. We talked a lot about interest rates, and you were a proponent of maybe further decreases, and then that December prices number kind of gave you pause a little bit. Just to discuss your thinking there. Now that we have some fresh data for January.
So one of the things I've noticed, consumer debt is at an all-time high from a credit card standpoint. Mm-hmm. I don't keep close to that information very well or very often. I don't know how much financing costs drive our overall cost of operations in the services industry. Whether, if I have a 15% tariff on the goods that I buy, or 50% of the goods that I buy from a country, and my cost of sales from a purchasing standpoint is 20%, that's, and that percentage of stuff that I'm buying from overseas is 10% of the 20%, it's 25% on 2%. Who cares? If financing is a big deal, and now I've got mortgage rates at over, or it was 6.85 yesterday, and it gets over 8% from a corporate financing standpoint for medium-sized and small companies. That could be, and I'm financing inventory, or I need to buy capital equipment or things like that. You can't stay there very long before it really impacts your profitability. And where do you make that up? You either reduce headcount, which is really difficult in the service industry, or you raise your prices. Mm-hmm. So there's the dynamic that says, let's keep interest rates or the Fed rate low so that we can start freeing up that cost of capital, which could drive prices up, or let's keep it there, and the cost of capital for businesses is high, and that starts flowing through to pricing. There are lots of people that are really, really bright working on those equations to figure out what to do. It seems like we still have a bit of time to work ourselves out of a really bad inflationary situation over a couple of years.
Yeah. Let's dive into a little bit on some of the particular industries. That's another thing that I always like to look at when I see the report. Which industries are trending upward in terms of growth, and especially as it relates to business activity and new orders. And accommodation and food services had a particularly good month, it seemed. And I think that's what the average person on the street thinks of. Hotels and restaurant type places, as Ricky Vaughn said in Major League, for those of you who go deep into the woods of movie scripts. But I think that's what the average person thinks of when they think of the services sector. And it was number 2 overall in overall growth in January, and was number 1 in business activity and new orders. Was that the industry of the month, so to speak? And was there any other good performances that stood out to you?
It seems like it, and this is not researched information on my part. Mm-hmm. Just watching one of the news channels, they were talking about the cruise industries were doing very well. There was one in particular that I think hit an all-time high in their share price a couple of days ago, which is which is good news, because if they're doing well, that means we're feeling confident enough to spend money and head out for a good vacation. Looking at the business activity, other industries, educational services was interesting. That in January, I didn't. That was a surprise for me. Is that one hitting the real estate rental and leasing on the other side of the coin was a surprise. With again, interest rates high, financing costs are high. You expect with that capital cost impact being higher, people aren't going to buy equipment; they're going to lease equipment. So I expected, with high interest rates, I'm expecting to see that strong on an ongoing basis, and that's just not the way the numbers are coming through. So that's something hopefully I'll be able to get some more insights into over time. But that one was a surprise to me. Having been in accommodation and food services for about almost 20 years of my career, it's nice to see that, because it's such a big employer. And it's where a lot of us get our joy, on a Saturday or a Friday.
Yeah. Well, I mentioned this is your first go around, in January. It's, that also means it's your first go around as chair with, seasonal adjustment factors, and those kicked in for this month. And, Tim Fiore on the manufacturing side cited them in his report on Monday, that they weren't nearly as big of a factor as they typically were at this time last year, which made the manufacturing data even that more encouraging. From a chair standpoint and your standpoint, seasonal adjustment factors, how do you feel about them, and how do they factor into the services data this month?
Yeah, so with us, it was first on the services side, it was very similar. 1/10%, 0.2% for various indexes. The big thing that we celebrated was the change for the business activity. Meant that it wasn't the 8th straight month of expansion. It was the 56th straight month of expansion, because that little tweak from the seasonal indexes, changing based on what our actual weather was and how the holidays fell and all that type of thing, ended up being just enough to get us into positive territory last summer for the one time we went below 50 for the business activity index. So for the 56th month in a row, we're seeing expansion. So that was a nice positive to see that string in line.
Yeah, can you just give it? I meant to ask you, why are they important? Why should they, be factored in? As someone who's, kind of getting into that weed in the data, for the first time. Just talk about, their impact and, why ISM, accounts for them.
Sure. So we have a statistician who looks at those numbers to get a sense for, based on what we thought the impacts were, typical seasonal impacts, typical weather, where holidays fall during the year, business days and shortening months in terms of number of business days and that type of thing. You project that out. That gets into the seasonal factors that get incorporated on a monthly basis. But then when we look backwards, we say, oh, this didn't exactly happen the way we expected it was going to. Tends not to be holidays, but it tends to be more economic behavior and weather behavior. So you look back on that and you look at the correlation and changes versus what you were expecting when you did the projection, and then you revise those numbers to be how they actually felt or actually fit, to give a better sense for how is the economy behaving, and specifically how is the service industry sector behaving. So very important aspect to do. If there were a major correction, I'd want to understand that more, exactly where that's coming from. But given they were 1/10 of a percentage point, 0.2 of a percentage point, and the confidence that I have in the team that's doing it, I'd really dig much more into it than that.
Yeah. Well, hey, Steve, this has been great as usual. I mean, those are all the questions that I had for this month. I mean, is there anything that I haven't asked or anything that we haven't talked about, you think might be important for our viewers to know about the Services PMI data?
And this is a repeat, I think, from last month or two, probably last month, is that the tariffs are understand when your suppliers are talking to you about tariffs and tariff impact. What does that actually impact in terms of their cost of services? Getting that breakdown on what you're actually buying and what the risk is there. Obviously, from a supply management standpoint, we're much more concerned with continuity of supply than we are with specific pricing. But that pricing is a fast follower in terms of continuity of supply and services. That's the one that I would look for is, okay, so tariffs go up. Who makes the run on toilet paper? What is our toilet paper? And making sure that we've got that covered so that we keep our businesses running.
Yeah. Well, hey, thanks a lot, Steve. I really appreciate it. An interesting month, and we'll see what February holds. Thanks for joining us today. And for more information, you can go to ismworld.org, where in a little bit we'll post a roundup article that details a lot of what Steve and I have discussed here, and as well as how markets and the economic community are reacting to the data. And if you'd like to be a part of ISM's manufacturing, services, or hospital business survey panels that compile data for the report on business, you can go to ismworld.org/join the panel to get more information on it. Doesn't take much time every month. And you'll get an opportunity to be a part of a vital economic report every month. So we'll see you back here in a month's time where we break down the February ISM report on business. And for Steve Miller and for some good people who helped us behind the scenes, Christina Cahill and Jennifer Stevens, my name is Dan Zeiger. We'll see you next time.